So basically, we could understand what is a functional currency and how we translate from foreign currencies to functional currency and from the functional currencies to a presentation currency. So the foreign currency translation and transaction is governed under Hong Kong AS 21, the effects of changes in foreign exchange rates. Basically, it deals with two situations where foreign currency impacts the financial statements. The first one is the foreign currency transaction. That means you enter into transactions with a foreign currency. You buy in foreign currencies or you sell in foreign currency. Another possibility is a foreign currency translation. You may have a foreign subsidiary or you may have a foreign associate. In order to consolidate, you have to translate from the foreign currency financial statements into your presentation currency so that we can consolidate. We cannot consolidate Hong Kong dollar with US dollar with UK pounds. Therefore, the first thing that we have to do before we can consolidate is we translate everything into one single currency. The principal issues involved is which exchange rate we have to use, because exchange rate change every day. So you have to decide which exchange rate we have to use. And once we have to use a different exchange rate, there can be an exchange difference. So how should we report this exchange difference? So exchange rates are quoted in two possible ways. The first one is the direct quotation, where we define 1 unit of foreign currencies equals to how many units of domestic currency. Say for example, we can say Hong Kong dollar 7.8 equals to US $1. Or the other way, we can quote in an indirect quotation, where we quote how many units of foreign currencies will be translated into 1 unit of domestic currency. For example, we may translate, say, 1 Hong Kong dollars equals to 0.128 US dollar. So how we quote will affect whether we have to multiply or divide the figures in order to have our translated figures. So, and also exchange rate are quoted in two markets, the spot exchange rate and the forward markets. Spot rate simply means the exchange rate which is quoted for immediate delivery on a particular day. So if we now go to the Hang Seng Bank, you ask, I want to translate into Japanese yen, they will give you a spot rate. But in addition to a spot rate, there can be a forward rate. Forward rate is the exchange rate quoted in a forward market for future delivery. Say for example, if I know that I have to pay Japanese yen 100,000 18 years after, I may try to quote a forward rate so that 18 years after, I will have the Japanese yen. So it may be quoted in 30 days, 60 days, 90 days, 180 days, etc. So it depends on the day when we need the foreign currency. So it may be a forward rate. So we will talk about foreign currency transaction first and then later foreign currency translation. No matter it is foreign currency transaction or foreign currency translation, the first thing that we have to do is we have to determine the functional currency. Functional currency is the currencies of the primary economic environments in which the entities operate. That means this is the currencies in which the company function. This is the currencies in which the company operates. Not all Hong Kong companies are operating in Hong Kong dollar. If all our manufacturing plant, if all our trading activities is in China, maybe we are operating in renminbi. If this is the case, the functional currency can be renminbi. If the functional currency is renminbi, any currency which is not in the functional currency is called foreign currency. Foreign currency is a currency other than the functional currency. So a Hong Kong company, if we determine that the functional currency is renminbi, then even transactions in Hong Kong dollar, they are foreign currency transactions. To make it worse, any company in Hong Kong can choose the presentation currencies in which they present their financial statements. So therefore, there may be a case where a Hong Kong company may choose Euro as the presentation currency. So therefore, they may have to translate from Hong Kong dollar, being the foreign currency, into the functional currency, which is renminbi, and then they present the financial statement in Euro, and therefore they have to translate from functional currencies into presentation currency. Therefore, we may have to translate from foreign currency to functional currencies and then translate to the presentation currency where we can do our consolidation. There are many factors to indicate the functional currency. Basically, functional currencies can be the currencies that mainly influence the sales price. Functional currencies can be the currencies of the country whose competitive forces and regulations determines the sales price. And functional currencies can be the currencies that mainly influence the labor, material, and other costs of goods and services. We usually call these three items the primary indicators. They are more influential in designing the functional currency. But we will consider all the factors. Therefore, we may also consider the currencies in which the financing is obtained, and we may also consider the currencies in which the receipts from operating activities are retained. All these indicators we determined, we consider. However, the indicators, the results may be mixed, and the functional currencies may not be very obvious. Therefore, in that case, the management may have to use its judgment to determine the functional currencies that most faithfully represents the economic effect of the underlying transaction. One entity, one functional currency. So we must determine what is the functional currencies of that entity. Say for example, in this case, we have an entity A, which is a Hong Kong incorporated company. They choose to report their financial statement in Hong Kong dollar, and therefore their presentation currency is Hong Kong dollar. Its head office is located in Hong Kong, but it only serves for accounting purpose. All the transactions, operations, trading, financing sourcing are located in UK, and actually all transactions are denominated in the UK pound. If this is the case, obviously they are functioning, they are operating in UK pounds. If this is the case, the functional currency is UK pounds. If the functional currency is the UK pounds, then even transactions in Hong Kong dollar, they are foreign currency transactions. So now we know what is functional currency. Another term that we have to understand is monetary item and non-monetary item. So basically, what is monetary item? Monetary item is the right or the obligation to deliver a fixed or determinable number of units of currency. Most important thing is it is a fixed or determinable number of units of currency. If this is the right to receive, this is a monetary asset. If this is an obligation to deliver, this is a monetary liability. Typical monetary items include cash, investment in bonds. If you hold the bonds until maturity, you can calculate how much you are going to receive. Accounts receivable, accounts payable, loans receivables, loans payable, you can calculate how much you are going to receive. Tax payable, also you can calculate how much you are going to pay. So all these are monetary items. Non-monetary items typically include investment in equity. If I invest in Hong Kong Bank, investment in shares, I don't know how much I can receive until I sell it. Of course, after I sell it, it becomes a receivable. Receivable is a monetary asset. But investment in shares, they are non-monetary. Similarly, for unearned revenue, for prepaid rent, you are not going to receive a particular number of units of currency, and therefore they are non-monetary. The same for the property, plant and equipment, inventory, intangible assets, they are non-monetary items unless you sell it. As I've said before, once you sell it, it becomes a receivable. Receivable is a monetary item because you know how much you are going to receive, but PPE, inventory, intangible assets, they are non-monetary because this is not a right to receive a fixed or determinable number of units of currency. It's important to distinguish monetary items from non-monetary items because the accounting treatment is different. If this is a monetary item, it can be a monetary asset or monetary liability. If this is a monetary asset or monetary liability, then at the year end, every financial year end, you have to use an update exchange rate, which we call it closing rate, to translate it again. Take an example. In this case, Arthur has got a functional currencies in dollar. They purchase goods with an invoice value of 250,000 FC on 1st of November, and it has been settled on 31st of January, and the year end is 31st of December. When we purchase something, of course, we debit inventory and we credit payable. In this case, because the functional currency is dollar, we should keep our record in functional currency. So if functional currency is dollar, therefore this transaction, FC 250,000, is a foreign currency transaction. For foreign currency, we have to translate it into the functional currency. So on that day, 1st of November, 250,000 FC can be translated using 1.5. 1.5. So FC 250,000 multiplied with 1.5, you'll get the dollar amount. Therefore, we debit inventory $375,000, and we credit accounts payable $375,000 because we have to keep the record in functional currency. At the year end, on 31st of December, we haven't settled this liability yet. Inventory is a non-monetary item. We don't need to retranslate if we keep this inventory at cost. However, for the payable is a monetary item. All monetary items must be retranslated at the year end using the closing rate. Closing rate means the year end exchange rate. At the year end, 31st of December, the exchange rate is 1.45. Therefore, 250,000 FC times 1.45 will be $362,500. So in terms of dollar, the accounts payable go down because the exchange rate go down, right? Therefore, we have to write down the accounts payable. It should be 362,500. So therefore, we debit accounts payable $12,500 to bring it down to $362,500. Accounts payable is a monetary liability. If a liability reduces, we got a gain, and therefore we recognize it as an exchange gain. So we debit accounts payable and credit exchange gain in profit and loss. This is what we have to do at the year end. Later, when we settle this accounts payable on 31st of January 2002, on that day, the exchange rate now becomes 1.48. So 1.48 times 250,000 is a little bit more than 362,500. It is $370,000. Therefore, on 31st of January, you really have to bring $370,000 from the bank. So you credit bank $370,000. With this $370,000, you can only settle a liability of $362,500 because in your accounts payable, the relevant accounts payable is $362,500. So you pay more than the liability that you can settle, and therefore this is an exchange loss, and therefore we debit exchange loss, profit and loss. This is what we have to do for a foreign currency transaction. Put it in a more complicated way in accordance with the Hong Kong AS21. So initial recognitions means all monetary and non-monetary item involving in a foreign currency transaction should be recorded in the functional currency. So everything should be recorded in the functional currency by using the spot exchange rate at the day of the transaction. For subsequent settlement at the year end, that means at the end of the reporting day, if this is a monetary item, we should translate it using the closing rate. Closing rate is the spot exchange rate at the end of the reporting day. So if the year end is 31st of December, we have to use the exchange rate on 31st of December in order to translate all monetary items. For any exchange difference, it will go to profit and loss. If this is a non-monetary item, if this non-monetary item is measured in terms of the historical cost, then there will not be any retranslation, right? Because you will keep on using the exchange rate at the day of transaction, so you don't need to retranslate, and therefore there's no exchange difference. However, if this is a non-monetary item that are measured at fair value, then you have to translate it using the exchange rate at the day when you give them a new fair value. So whether the exchange difference will go to P&L or reserves, it depends on how you translate, how you value the underlying asset. So if this is a property, plant and equipment, for example, revaluation of property, plant and equipment go to reserves. Revaluation reserve, and therefore the related translation difference will go to reserves. If this is a investment property, for example, investment property, any revaluations will go to P&L, right? And therefore, any exchange difference related to the fair value difference of the investment property will go to P&L. This is important because basically most of the items are not being kept at the historical cost. If they are being kept at the historical cost, then of course there's no exchange difference. However, if they are not being kept at the historical cost, then we have to use a new exchange rate at the day when we give them a new value.